Hey everyone, I am here with our President Emeritus, Mr. Mike Smith, talking about long-term care. There's a lot going on in our industry right now. We were just talking about it, prepping for this podcast. There's also a huge opportunity with long-term care. So in this episode, really it's going to be kind of teacher and student. He's the expert on this, and I'm going to learn along with you guys and try to ask the questions that you might be asking as well.
Hey, well, Gillen, I'm glad to be back in the podcast hot seat because this is going to be a hot topic. Long-term care is a crisis that's going to kick America's butt here in about 5 more years. So this is a good opportunity for us to kind of set the stage of why I think that way. And when I hear you call me President Emeritus, I already think that I'm getting old. So I'm not sure what that means, but let's just get into it and figure it out, okay? Well, I guess I did my first CE class in 1997 when HIPAA was passed, the Health Insurance Portability and Accountability Act. And that did a lot of things. We always think about, well, it did privacy standards and it put those little slips in our credit card statements that say how they're going to use our information. But what people forget is that HIPAA also created tax qualified long-term care products. And back in the early and late 90s, long-term care was kind of revving up and it was kind of the big untapped market. So all these insurance companies started getting into the tax qualified long-term care market scene. And we did our first CE, and if 50 people RSVP'd, there'd be 75 people that would show up. And I'm making a point here that I'm going to wrap this back up into Medicare here in a minute. There was a lot of interest in this. However, what happened over the course of the next decade was that people got the policies or they did not because they were determined that the government was going to take care of them as a solution. And those that bought the policies oftentimes bought them on a 10-pay basis, and they were paid up by 2007, 2008. Smartest decision they've ever made. However, in that course of that one decade, what happened was the actuaries realized they priced this product wrong. And the people, they weren't dropping the plan. They were keeping the plan. Why'd they buy the plan? They bought the plan because they were caregivers to begin with. So I did not have to sit down with anybody and say, these are the risks and these are the costs. The people that were the caregivers were making the phone ring, calling, saying, we want to be protected because we understand how much it costs and we understand the emotional stress that it causes on families. So why am I saying this? What I ended up realizing when you take all this information and boil it down into one simple sentence, it's this. Long-term care is an emotional sale that ends in a common sense financial decision. Why is it emotional? Because it's expensive, because it's usually the eldest daughter that has to stop what they're doing, put their life on hold, can't take care of their family. They're in the sandwich generation, taking care of elderly parents, taking care of their own kids. They can't work a career, or if they do, they have to step back. They can't get advancement opportunities. They can't make 401 contributions because they're having to take care of aging parents. Their life stops. Anybody that's listening to what I'm saying is probably shaking their head going, oh my God, is that so true? Because they've lived it. And when you've lived it, you understand how emotionally stressful this can be, how it can just tear the fabric apart of your family because jealousy happens. Mom's got to be taken care of. It's the oldest sister that has to do it. And the other two kids that don't live in the same area get a pass. And they only see mom on Mother's Day or Easter or Christmas. And then they all talk about, well, it's really getting worse. What are we going to do? And unfortunately, people have made the decision by them that they've either got long-term care insurance or they didn't, and most didn't. In fact, if you look at the statistics, only about 1% of the United States has a long-term care policy in place. What does that mean? A long-term care policy can come in many different varieties. But really, let's take that a little bit more of a broad stroke and say, what is your long-term health care plan? How have you decided that you're going to take care of this? And when you sit down with somebody and you say 70% of every couple that's walking in the United States today is going to experience a long-term care episode in their family, 70%, people might say, oh, that's a bunch of baloney. It's not. It's true. So what is a long-term care episode? 90 days or longer of some form of care. Well, in most cases, people are going to need that care for longer than 90 days when they go on claim. That could start with a broken hip. I bet everybody knows somebody that's had a broken hip. And what happened before that broken hip and what happened after that broken hip is a lifestyle change that doesn't equate. And the people that plan for it have care where they want it, when they need it. And that's what long-term care insurance does. So I'm setting the stage to say we have a very complex problem with a bunch of people running around that have their head in the sand about the risk. If I told you you got a 70% chance of having a car accident if you go home today, would you want to go home today? Probably not.
No.
And yet, here we are talking about something nobody really wants to talk about. If I sat down at lunch today and said, "Hey, Gillen, you've got a brand new baby, you're changing diapers, but one of these days somebody's going to need to change your diaper," you're probably not going to be able to relate to that. Whether you're 26 or 56 or 76, it's not a subject you want to think about. We all think of ourselves as invincible, bulletproof people that are never going to need any care. We're going to have the grace of God to die in our sleep, and 70% of the time, that does not happen. So what's the plan?
Mm-hmm.
And when you look at the plan, you have really three options. This is the three options I see in any long-term care thought process. Either you're going to decide to self-insure. Okay, great. How are you going to do that? What money are you going to use right now that's going to pay for that in 20 years?
Mm-hmm.
Okay, we can get into that. Or let's talk about Medicaid welfare, because most people think Medicare is going to take care of them. I just mentioned three words: Medicare, Medicaid, and welfare. I'm going to tell you Medicare is not designed to take care of long-term care. It's designed to take care of acute care illnesses. You get sick, we help you to get better. We pay claims until we decide that that claim is going to become chronic in nature. And at that point, let's use a stroke as an example. Family comes together, and 20 days later, mom and dad been in the hospital. Doctor team comes out, says, "Family, guess what? Mom's not going to recover. You need to start thinking about skilled nursing facilities, assisted living facilities, and long-term care facilities." Family looks at each other and says, "Who's going to pay for this?" Oh, crap. So that Medicare plan is not going to work. Then they start saying, "Well, let's go on Medicaid." But then they look at that and they decide, well, that's not going to work either, because in most states, there's about a 5-year look back. So if you applied for Medicare today, you might not get benefits for 5 more years. So it goes back to the question, who's going to pay for this? And Medicaid is welfare. Let's make that very clear, because you go where they say there's a room when you qualify, if you qualify, and that might take a long time to
You
qualify.
have to dissolve any assets you have, right?
You do have to get rid of your assets, because there's a test that you can't have above a certain amount of income or assets. You can keep a few things like your wedding ring, your house, maybe a car, but if you think you've got a Charles Schwab account with $100,000 in it, that is not going to help you to qualify for Medicaid welfare. You're going to have to get rid of that, and typically there's about a 5-year period. So really, Medicaid welfare is not really an option for most people. So we're going to try to self-insure this risk? Okay, well then, if you had a stroke today, where would you go get the money? And in most people's mind, they're going to say, well, I've got a CD, or I've got a liquid account down there at the credit union. Well, how much is in there? Oh, I don't know, $100,000. Okay, and that's today in 2024. And let's say that you file that claim in 2034, when the cost of care might be $10,000 a month. That's going to give you about 10 months of care. The average claim lasts about 2.5 to 4 years. So what are you going to do when you run out of money? Which one of your kids do we need to call today to ask who's going to take care of you when you have that stroke? Who's going to put their life on hold and take care of you? So this is why I say this is an emotional sale. People get upset. It's not fun to talk about. It's expensive, but it ends in a common sense financial decision. And that's where I want to pull this back into where insurance comes into the picture. Where do insurance agents, insurance brokers, professionals come into the solution part of this, where they have the products and they have the knowledge to give to people today to help them from being broke tomorrow? That's what we do. We protect people's lives. It makes no sense to build 30 years worth of assets only to leave the back gate open to a long-term care claim, and 2 or 3 short years later, it's all gone. Your whole working life wasted in a nursing home or assisted living facility. That's not what you want. That's not what I want. Yet that's what happens to 70% of the couples walking around in the United States today. So what's the answer? Well,
What is the answer, Mike?
right now, what we're starting to see are a couple of, I guess, precursors of what I think will ultimately happen in the form of various states that are legislating this issue. And the first one was Washington. They came up with what was called the Washington CARES Act. And what is this? It's a mandatory payroll tax of 0.58%. So let's make some math simple here. Let's say you made $100,000. a 0.058 kind of a tax percentage comes out to $580 a year.
Right.
What can you possibly get for $580 a year? Not a lot. In fact, that'll pay for about $100 a day. That's $36,500 a year, and then that benefit's gone. And that's in today's dollars. And if these people like you are young and having to pay this tax, and they're going to have to pay this tax for 15, 20, 30, 40 years, that's not a good value. So do you want to now live in the state of Washington?
Nope.
Or would you rather just say, well, I'm just going to move to Oregon, but I'm going to work in Washington, and if I live in Oregon now, I don't have to pay that tax. So this is why it can't be a state solution. Each state, Minnesota, Pennsylvania, Ohio, there's about 14 states that have some form of long-term care legislation being discussed. Right now, California's got one of the most aggressive approaches that, if it passed, would basically become a single-payer, cradle-to-grave system. How in the world are they going to possibly tax enough people in California to afford that, when you've got people leaving California in droves because they're overtaxed already? Point being, this is not a state-based solution. So then we have to look to Uncle Sam and say, well, we all goofed. We didn't plan for this. There's a 70% risk. How are you going to take care of it, Uncle Sam? Medicaid's not going to be able to afford it. That state federal program that we call Medicaid is the biggest line item in the state of Texas. It surpassed education a couple of years ago. And because of our
Whole other topic.
because of the graying of America, Texans included, that's only going to become more strained. You've got more people that are retiring, no longer contributing to the tax base, taking Medicare benefits, taking Social Security benefits, taking these social programs, and now they didn't pay for long-term care insurance. They didn't plan for long-term care insurance because they didn't want to think about somebody changing their diaper. That's not a pleasant conversation.
No.
But now that somebody's having to pay to change the diapers, they want Uncle Sam to pay for it, don't they? And so, unfortunately, my opinion of 30 years of observation of this problem, this will have to be a fix that will increase our taxes. And just like what we had in Medicare with the increase in tax back in the late 80s, when payroll taxes nationwide, not state by state, but nationwide, it becomes an increase of a federal tax. At that point is when we might see the birth of a new part of Medicare. We'll call that Medicare Part E. Even though really there's a Medicare Part E that people don't know much about because that's where demonstration projects happen, we'll call it Medicare Part E for the sake of this cool podcast we're having, all right?
All right.
So now Medicare Part E comes along, and everybody gets charged a 1% payroll tax, and the employer also gets charged a 1% payroll tax, and now all of a sudden that $100,000 income is really generating about a $2,000 premium, and now all of a sudden we get a little bit of meat on the bone of a long-term care plan. Is that meat on the bone just an extension of the Medicare Advantage products that are available in today's marketplace? Or is this where we interject that there's been some discussion about pulling back on the funding of Medicare Advantage plans?
Right.
And yet we're asking to expand. They can't do it with the money they have, so they're going to have to generate more money.
Yeah.
How's that going to happen? They're going to have to mandate new payroll taxes. Because after 30 years of doing this, I can tell you the dogs ain't eating the dog food when it comes to traditional long-term care insurance. They don't find the value. I'm not going to pay for something for 30 years and die and not use it.
Pretty high too, right?
They're very
So
expensive.
if you're like already not even accepting your own fate, like you're saying, like you don't even want to think about that, much less pay big premiums for something you don't even
All
want
right.
to think about. Yeah.
I'm 58. My wife's 57. If we were to buy a mid-range long-term care plan, we're looking at $6,000 to $8,000. What I said back in a minute ago about how we did our first CE back in the 1990s, there were 100 plus insurance companies that were in the long-term care business. 100. And now how many are there? You can count them on one hand. What happened? These companies lost their shirt. They mispriced the product. The underwriting was a little too flimsy. They let too much risk in. The people that bought the plans didn't drop the plans. Every actuarial assumption was wrong, 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 which is why we've seen major companies like John Hancock taking 60, 70, 80, 90% rate increases. Companies like Genworth that are selling out, trying to get out of the business. I mean, it's a problem,
Mm.
and it's not going away, and those baby boomers are going to start knocking on the door of a claim here pretty soon. So
Right.
what are we going to do as an industry to solve the problem? And therein lies the opportunity, because it always comes back down to independent agents educating people, telling them about the problem. That's not a lot of fun, but offering them the solution, that's where we come to the table. And whether that's going to be with a velvet hammer of the government coming in with a payroll tax, probably will happen, or if it's going to be you being able to convince somebody that they need to take personal responsibility, because these products will then give them the options to be where they want to be when they need it to be there. If that's assisted living or aging in place at home, we need to help them to finance this, because self-insuring is not really an option for most people. If you've got $10 million in the bank, oh, maybe we can self-insure.
Yeah.
But in most people's bank, they don't have $10 million.
Right.
And even if they have $1 million, that's still $1 million problem, because we're not talking about today's dollars, which could be $6,000 to $10,000 a month. So let's just call it $50,000 to $70,000 a year for long-term care. In 20 years, that'll more than triple. So if you got a now $200,000, $250,000 annual claim, you and mom, yeah, you got $1 million, but what you got is a problem. And that's going to just eat all those assets up. And then what's going to happen? All the people that were supposed to inherit that money are going to start saying, well, what happened? More importantly, what didn't happen? Why didn't mom and dad buy long-term care? And they're going to start rifling through the papers, and they're going to find some guy named Gillen who tried to sell them a long-term care policy 20 years ago, but Gillen wasn't able to get him to do it. So they're going to come after you and say, hey, buddy, you didn't get our parents to sign on the dotted line, and now we're not going to get any inheritance. We're going to sue you. So how are you going to protect you? Well, that's why you see a lot of financial planners today that'll actually have a disclosure form that I've offered you long-term care insurance. I have explained this problem. You have denied that there's a problem and chosen not to purchase a long-term care protection package. Sign right here, because in 20 years, when your grubby little children come to me and want to sue, I'm not going to get sued. Okay? So that's the problem. But what's the solution, really? What is the solution? And I believe that the solution is going to be independent agents educating people on what the problem is, and then talking to them realistically about what the insurance contracts are today. You can either buy traditional long-term care insurance, or you can buy a hybrid plan. Most people are buying the hybrid plan. What is that? It's a combination of either a life insurance or an annuity product with an accelerated benefit to pay for chronic illnesses or long-term care illnesses. And there's different ways they can be paid out: reimbursement or indemnity. Indemnity means if you just have a claim, the healthcare practitioner is certified your condition will last for 90 days or longer. Okay, no problem. You file $1 worth of a claim that month, an indemnity plan. If you get $5,000, they pay $5,000. What do you do with the other $4,999? You might want to give that to that daughter who just had to forfeit that contract that they were going to get an advancement at the bank, or that they can't make their 401k payments because they had to stop their life to take care of mom or dad. That kind of cash indemnity product can go to help pay for that loved one to take care of you while you age in place at home.
Mm-hmm.
So that's one way to do it. Reimbursement, you submit $1 worth of claim, you get reimbursed $1 worth of claim. Now, is there more to this topic that we could talk about? Absolutely. I could go on for another 2 hours, but I won't. I'm just saying right now, to set the stage up for all those agents that might be out there listening, that there's a problem, you need to tune into it. And the next time you read some article from AARP or wherever you get your information, read it. Because these people have a problem, and you could be the answer to that. So we at the brokerage have always been leaders by being able to see into the future and look at where the problems are and steer those thoughts into how we offer solutions. We are in the business of identifying problems and bringing solutions to the table. We have done that for over 50 years. We've done that for 50 years, and we're going to keep doing it. And so that said, I just encourage everyone who's listening today to understand what the problem is, realistically admit there's a problem, and they have that problem too. They're part of that 70%. And I'm going to ask a rhetorical question to the audience. What are you doing to solve your own problem?
Mm-hmm.
And if you don't have an answer to that, that's when you need to give us a call. We have a whole team full of people here that are in our life department, and they help people with traditional long-term care and also hybrid products for life insurance and annuities. So my challenge to the folks listening today is don't be a part of the problem, but instead be a part of the solution.
Mhm. So we've covered a few different routes, like you said, right? There's self-insure, probably not a good plan unless you're already quite wealthy. And even then, you may want to still invest in private insurance because why would you want to lose money when you could insure, even if you have money, right?
Right.
Um, there's the welfare option, which, let's be honest, you said there's a waiting period
Mm-hmm.
anyway. And if you're not already kind of in poverty, you basically have to put yourself into poverty,
Mm-hmm.
and then you are at their mercy. You kind of have to just trust the government programs to take you wherever they can take you. I've seen that in my own family, great grandparents. I've seen that. I've personally watched this with my own grandparents, Alzheimer's and how that all went down, and that was more of a self-insurance situation there. And there were challenges. And then I've seen my great grandmother, which was more the Medicaid and that path. Um, it's
Mm-hmm.
it's real.
And I bet
It's real.
every person that's listening to this is thinking of someone, friend, family, that's going through this right now. It is such a common problem that it baffles me why people have ignored it. And what you just said a minute ago, some people that have enough money that could self-insure could still want to buy this product. I always ask those people, how did you get to be so wealthy? Because you made a series of very smart decisions.
Mhm.
And this is just one more of those smart decisions.
Yeah.
So peel out whatever $100,000 that you have accounted for that stroke that you may or may not have,
Mhm.
and let me show you how I can make that money become 3 times as valuable as what it's been allocated for by utilizing insurance contracts. You offer solutions. This is just a simple technique to leverage your money. But first, people have to admit there's a problem.
Yeah. I also like how you hinted a minute ago about the caretaker aspect, the family member. Um, every culture is different, and some cultures it's multi-generational. The United States would tend to be that way, but even still, if you have any relationship with your parents, you're going to want to help out. And to your point, um, there's the financial aspect, and then there's the emotional aspect. And to have a plan where the claim is, you said 5,000, and there's this balance, and okay, now this can help you with you just took a promotion opportunity you didn't get because you couldn't focus or 401k or whatever it might be to help offset that. That's an important consideration for sure.
Yeah. Well, I will say that there are many insurance companies out there that have a qualified type of plan where you could have some of the money paid for premiums deducted through businesses or personal income tax returns. There are a ton of, you know, advanced financial planning departments at companies like Mutual of Omaha and others that are willing to do calls with agents. We're able to also help with those calls. In fact, most of the long-term care products that we sold, somehow I've had my fingerprint in the sale of that only because the agent was asked about it. Hey, can you get me a long-term care quote? And when the agents call me, they're like, hey, do y'all still do that stuff? And I can already sense what's going on.
Mhm.
I said, well, Gillen, what motivated you to call me to request a long-term care quote? Well, my client asked me about it. Oh, okay. Well, let's talk to your client. And when I get that client on the phone, I say to them, hey, why is it that you're asking about a long-term care policy?
Mhm.
Well, because we're caregivers or we have been caregivers.
Mhm.
There's 3 categories: those that have been caregivers,
Mhm.
those that will be caregivers, and those that will need care.
Yeah.
You're going to fit in one of those buckets.
Yeah.
This problem is not something you can ignore, so we have to deal with it. And again, point being is that in the next 3 to 5 years, I just encourage people to watch as this problem becomes more and more in the limelight. As these baby boomers start hitting their early 80s and file these claims, and we have the lack of caregivers, the facilities that are going to be chock full of people needing care,
Mhm.
Medicare denying claims because they're never intended to be long-term care in
Yeah.
nature. It's a problem.
And declining birth rate.
Mhm.
So to assume that it could be purely solved through subsidies and taxes, maybe not this time around. The math just doesn't seem to check out.
No.
But that's not reason to be in panic, right? To your point, um, let's start planning.
Mhm.
Let's start planning. And, this podcast, that's what we're about, is to help inform you all of what's going on in the industry. So you as an agent can prepare your own business. And it sounds like there's a lot of opportunity right now.
Yeah, well, I appreciate you hosting this just to put the topic on the table and bring awareness to the subject. And as I said earlier, the brokerage has always been a part of the solution. So I encourage people to just keep that in mind as these challenges present themselves, either through a prospect that asks about it or perhaps something that may be happening in their own family. Give us a call on this thing through a solution together.
All right. Thanks, Mike.
You bet.